Every so often, the seemingly stable pillars of the global economy tremble, then shatter. For investors, businesses, and entire nations, the sudden collapse of stock markets represents not just a loss of wealth, but a seismic shift in the economic landscape. These moments are etched into history, defining generations and reshaping the very fabric of capitalism. Today, we embark on an investigative journey, dissecting three such catastrophes: the Wall Street crash of 1929, the global financial crisis of 2008, and the swift decline of 2020. Each event, unique in its genesis, offers critical insights into the vulnerabilities and resilience of our financial systems. Our first stop is the late 1920s, an era famously dubbed the Roaring Twenties. According to historical accounts from economists like John Kenneth Galbraith, this period was characterized by unprecedented prosperity, technological innovation, and a burgeoning stock market. Many Americans, from seasoned financiers to ordinary citizens, began to believe that stock market gains were a guaranteed path to wealth. This widespread optimism, fueled by easy credit and speculative fervor, created an environment where the perceived value of assets far outstripped their underlying fundamentals, setting the stage for an inevitable reckoning. Leading up to the crash, an undeniable speculative frenzy gripped the nation. Financial historian Charles Kindleberger noted the pervasive use of margin buying, where investors purchased stocks with as little as 10% down, borrowing the rest. This amplified potential gains but also magnified losses. As stock prices climbed, driven more by speculation than intrinsic value, the market became increasingly fragile. The Dow Jones Industrial Average surged from approximately 63 points in 1921 to a peak of 381 points in September 1929, an increase of over 500%. This meteoric rise, while exhilarating, was built on an unstable foundation of debt and unchecked optimism. On Thursday, October 24, 1929, the first major crack appeared. Known as Black Thursday, the market opened to heavy selling, and prices plummeted. Reports from the New York Stock Exchange indicated a volume of nearly 13 million shares traded, an unprecedented number at the time. Prominent bankers, including J.P. Morgan & Company and Chase National Bank, intervened, pooling funds to buy stocks and stabilize the market, a move reminiscent of the 1907 panic. For a brief moment, their efforts seemed to work, and the market regained some ground, offering a false sense of security that the worst had passed. However, the reprieve was short-lived. The following Monday, the market slid again, and on Tuesday, October 29, 1929, Black Tuesday, the bottom fell out. The selling intensified dramatically, with nearly 16 million shares traded, overwhelming the stock exchange's ticker system. The Dow Jones Industrial Average lost 12% of its value in a single day. According to financial historian Robert Sobel, many investors saw their life savings vanish instantly. This day is widely regarded by historians as the definitive beginning of the Wall Street crash, though the market continued to decline for years, eventually shedding almost 90% of its value from its 1929 peak. The stock market crash quickly rippled through the broader economy. The crisis was not confined to American shores. Historians emphasize that the U.S. crash, coupled with its protective trade policies like the Smoot-Hawley Tariff Act of 1930, severely exacerbated global economic conditions. This act raised tariffs on over 20,000 imported goods, prompting retaliatory tariffs from other nations. International trade plummeted, exacerbating the depression worldwide. According to economists Barry Eichengreen and Peter Temin, the lack of coordinated international response and the rigidity of the global gold standard system further compounded the crisis, turning a severe downturn into the prolonged agony of the Great Depression. The human cost of the Great Depression, catalyzed by the 1929 crash, was immense. Unemployment rates soared to nearly 25% in the U.S. by 1933, leaving millions without work or income. Families lost homes, farms, and life savings. Dorothea Lange's iconic photographs captured the destitution of the era, from soup lines to migrant worker camps. Social scientist Robert S. McIlvaine documented the widespread psychological trauma, loss of dignity, and deep societal despair. The crash was not merely a financial event, it was a profound human tragedy that tested the resilience of a nation and forced a re-evaluation of economic responsibility. The monumental fallout from 1929 prompted a transformative response: President Franklin D. Roosevelt's New Deal. This series of programs and reforms fundamentally altered the government's role in the economy. Key legislative actions, as cited by historians William E. Leuchtenberg, included the creation of the Securities and Exchange Commission (SEC) in 1934 to regulate the stock market and prevent future abuses. The Glass-Steagall Act separated commercial and investment banking, aiming to curb speculative risks. Additionally, the Federal Deposit Insurance Corporation (FDIC) was established to insure bank deposits, restoring public trust in the banking system. These measures aimed to build a new financial architecture, preventing a repeat of the 1929 catastrophe. From the ashes of the 1929 crash, critical lessons emerged. Historians of economic policy emphasized the necessity of financial regulation to curb excessive speculation and protect investors. The importance of a robust social safety net became apparent, leading to programs like Social Security. Perhaps most significantly, the crisis highlighted the critical role of government intervention during economic downturns, a sharp departure from earlier laissez-faire ideologies. While imperfect, these lessons would influence economic policy for decades, yet, as we will see, not fully prevent future crises, merely change their forms and triggers. Fast forward to the early 21st century. The global economy had evolved significantly since 1929, with greater interconnectedness and complex financial innovations. Yet, the seeds of another devastating crisis were quietly being sown. The 2008 global financial crisis was not triggered by the same factors as 1929, but it shared a common theme: unchecked speculation and systemic risk. This time, the epicenter was the U.S. housing market and the intricate web of derivative products built upon it. As former Federal Reserve Chairman Ben Bernanke would later explain, this crisis was less about individual bad actors and more about systemic failures within the financial architecture. The crisis began with a massive housing bubble. Driven by loose lending standards, low interest rates, and the belief that housing prices would never fall, millions of Americans took out subprime mortgages, loans issued to borrowers with poor credit histories. As documented by financial journalist Michael Lewis in The Big Short, lenders often ignored borrowers' ability to repay, lured by the profits from originating and bundling these loans. Homeownership rates peaked around 69% in 2004, indicating a widespread belief in the stability and continued appreciation of the real estate market. This expansion was aggressive and ultimately unsustainable. What amplified the housing bubble into a global crisis were complex financial instruments. Investment banks bundled thousands of these risky subprime mortgages into seemingly safe securities called mortgage-backed securities, or MBS. Then, they sliced and repackaged tranches of MBS into even more complex derivatives known as collateralized debt obligations, or CDOs. Rating agencies, often incentivized by the very banks issuing these products, assigned them high investment-grade ratings, masking their inherent risk. As former Treasury Secretary Timothy Geithner explained, this opacity made it nearly impossible for investors to assess the true value or danger of what they owned, creating a house of cards. The housing market began to falter in 2006, as interest rates rose and adjustable-rate mortgages reset to higher payments. Many subprime borrowers, unable to afford the increased costs, defaulted on their loans. Foreclosures soared. As the supply of homes on the market increased and demand waned, housing prices began to fall, puncturing the bubble. This decline, initially localized, rapidly metastasized. Reports from the National Association of Realtors indicated a sharp decline in median home prices, shattering the illusion of perpetually rising values. The dominoes, built from hundreds of thousands of risky loans, began to fall. As defaults surged, the value of MBS and CDOs plummeted. Financial institutions holding these assets, including banks, hedge funds, and insurance companies, faced massive losses. The intricate interconnectedness of the global financial system meant that no major institution was immune. Banks, suddenly uncertain of each other's solvency, stopped lending to one another, leading to a severe credit crunch. This froze financial markets and stifled economic activity. The Federal Reserve, under Chairman Ben Bernanke, recognized the grave danger of systemic collapse, a situation where the failure of one major institution could bring down the entire system. The crisis reached its boiling point in September 2008. After attempts to find a buyer failed, the investment bank Lehman Brothers, a prominent institution with 158 years of history, filed for bankruptcy on September 15. This event, as analyzed by economist Carmen Reinhart and Kenneth Rogoff, this time is different, sent shockwaves through the global markets, triggering a full-blown financial panic. It marked the largest bankruptcy in U.S. history and signaled that even giant institutions were not immune. The Dow Jones Industrial Average plunged, and fear gripped investors worldwide, demonstrating the fragility of confidence in financial markets. In the immediate aftermath of Lehman's collapse, the U.S. government faced agonizing choices. To prevent a cascade of failures, major interventions were enacted. The Treasury and Federal Reserve orchestrated massive bailouts for struggling institutions like AIG, Fannie Mae, and Freddie Mac. The Troubled Asset Relief Program, TARP, signed into law by President Bush, authorized $700 billion to purchase toxic assets and inject capital into banks. Critics, including many members of Congress, decried these bailouts as unfair to taxpayers and a form of moral hazard. However, proponents, such as Treasury Secretary Henry Paulson, argued they were essential to prevent a complete meltdown of the financial system, emphasizing the dire consequences of inaction. The U.S. financial crisis quickly spread globally, demonstrating the profound interconnectedness of modern economies. European banks, heavily exposed to U.S. mortgage-backed securities, faced their own crises. Iceland's entire banking system collapsed. Governments around the world were forced to intervene to stabilize their financial sectors. The International Monetary Fund reported a significant contraction in global trade and investment, leading to a worldwide recession. The crisis highlighted that even with more sophisticated financial markets than in 1929, the interconnectedness created new avenues for rapid contagion across borders, proving that national economic issues could quickly become global catastrophes. In response to the 2008 crisis, the U.S. enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This sweeping legislation aimed to prevent another crisis by increasing oversight, curbing risky practices, and protecting consumers. Key provisions included establishing the Financial Stability Oversight Council (FSOC) to identify and monitor systemic risks, and the Consumer Financial Protection Bureau (CFPB) to safeguard consumers. While lauded by some, like Senator Christopher Dodd, for its comprehensiveness, critics argued it was overly complex and stifled economic growth, highlighting the ongoing debate about the appropriate level of financial regulation. Beyond regulation, the Federal Reserve implemented unprecedented monetary policies. With traditional interest rate cuts exhausted, the Fed introduced quantitative easing, QE, purchasing massive amounts of government bonds and other securities to inject liquidity into the financial system and lower long-term interest rates. This unconventional approach, previously only theorized, marked a significant expansion of central bank powers. According to analysis by the Federal Reserve Bank of St. Louis, QE aimed to stabilize markets and stimulate economic recovery, but it also sparked debates about potential inflation and asset bubbles. The crisis fundamentally reshaped central bank tools and their role in managing economic stability. The 2008 crisis provided new, stark lessons. It underscored the concept of too big to fail, where the collapse of certain institutions poses such systemic risk that government intervention becomes unavoidable. It revealed the dangers of an opaque, interconnected financial system and the need for rigorous oversight of complex derivatives. Most importantly, it demonstrated the imperative for rapid, decisive central bank and government action to prevent a total economic collapse. While the New Deal aimed at specific market abuses, 2008 forced a deeper understanding of systemic risk and the challenge of managing global financial interconnectedness. Just over a decade after the 2008 crisis, the global economy faced an entirely different, unprecedented challenge: the COVID-19 pandemic. Unlike 1929's speculative bubble or 2008's financial engineering, the 2020 market crash was triggered by an external, non-financial shock. As global supply chains ground to a halt and governments mandated lockdowns, economic activity plummeted worldwide. Investors, gripped by uncertainty and fear, rapidly pulled money out of risky assets. The World Health Organization's declaration of a pandemic fundamentally altered global economic behavior overnight, creating a crisis of demand and supply simultaneously. The market reaction was swift and brutal. From its peak on February 19, 2020, the S&P 500 index fell by nearly 34% in just 33 days, marking the fastest bear market decline in history. Volatility soared to levels not seen since 2008. According to reports from the Congressional Research Service, the uncertainty surrounding the virus's spread, the duration of lockdowns, and the effectiveness of potential vaccines caused widespread investor panic. Unlike previous crises where underlying structural issues unraveled over time, 2020 was an immediate, sharp contraction, a sudden stop to a robust economy, causing a liquidity crisis as everyone tried to sell at once. Drawing on the lessons from 2008, governments and central banks responded with unprecedented speed and scale. The U.S. Federal Reserve cut interest rates to near zero, restarted quantitative easing, and established numerous emergency lending facilities to ensure market liquidity. Congress passed the CARES Act, a $2.2 trillion stimulus package, providing direct payments to citizens, enhanced unemployment benefits, and aid to businesses. Economist Christina Romer, known for her work on the Great Depression, highlighted how rapid and forceful this intervention was compared to historical responses. This coordinated global effort aimed to bridge the economy through the sudden stop, preventing a deeper, more prolonged recession. Remarkably, due to these aggressive fiscal and monetary interventions, the market experienced a historically rapid V-shaped recovery. By August 2020, the S&P 500 had recovered all its losses, and by year-end, it was hitting new record highs. This swift rebound, as noted by analysts at J.P. Morgan Chase, demonstrated the power of decisive policy action in mitigating the financial impact of a non-financial shock. While parts of the real economy, particularly small businesses in certain sectors, struggled for longer, the financial markets largely shrugged off the initial panic, distinguishing 2020 from the lingering aftermath of 1929 and 2008. Despite the market's swift recovery, the social and economic fallout from COVID-19 was profound and uneven. Millions lost jobs, particularly in service industries, and unemployment rates spiked, though not to 1930s levels. Supply chain disruptions led to inflation and shortages. The pandemic also accelerated trends like remote work and e-commerce, fundamentally reshaping industries and consumer behavior. While the financial system itself proved more resilient than in previous crises, the human toll, from health impacts to economic displacement, was immense. The Congressional Budget Office reported a significant increase in national debt, reflecting the cost of sustaining the economy through the shock. The 2020 crisis offered crucial new insights. It highlighted the potential for non-financial, external shocks to trigger severe economic downturns, demanding adaptable and comprehensive crisis management. The swiftness of government and central bank responses demonstrated the effectiveness of aggressive, coordinated intervention in preventing a systemic collapse and fostering recovery. It also underscored the evolving nature of risk in a globally interconnected world, where a public health crisis can become an economic calamity almost overnight. The experience reinforces the idea that each crisis, while sharing common threads, presents unique challenges requiring tailored, yet rapid, solutions. When we compare the three crashes, their primary triggers stand in stark contrast. The 1929 crash was largely an internal market phenomenon, driven by rampant speculation, excessive margin buying, and a lack of regulation. The 2008 crisis stemmed from the complex interplay of a housing bubble, predatory lending, and opaque financial instruments that created systemic risk. In contrast, 2020 was initiated by an exogenous shock, a global pandemic, that forced a sudden halt to economic activity. As financial historian Neil Ferguson often points out, while human nature's speculative tendencies remain constant, the specific vulnerabilities of the system evolve with each era, making prevention a continuous challenge. The impact of each crash reverberated globally, albeit with varying intensity and duration. The 1929 crash led to the Great Depression, a decade-long global economic contraction exacerbated by protectionist trade policies. The 2008 crisis triggered a worldwide recession, characterized by a credit crunch and government bailouts across continents, but recovery was swifter due to coordinated central bank action. The 2020 crash, while causing significant initial disruption and localized hardship, saw a rapid market recovery due to unprecedented fiscal and monetary stimulus, though supply chain issues and inflation lingered. Each crisis exposed the growing interconnectedness of nations, demanding increasingly global responses. A critical through line is the evolution of financial regulation. After 1929, the U.S. government instituted foundational measures like the SEC and FDIC, recognizing the need for market oversight and depositor protection. The 2008 crisis led to Dodd-Frank, a comprehensive overhaul designed to address systemic risk and protect consumers from predatory lending. While 2020 didn't necessitate a new regulatory framework of the same scale, it tested existing mechanisms and prompted discussions around digital asset regulation and global health preparedness. As economic historian Liaquat Ahamd writes, each crisis acts as a painful but potent teacher, forcing improvements in regulatory frameworks, albeit often playing catch-up. The role of central banks has transformed dramatically across these periods. In 1929, the Federal Reserve's response was criticized by economists like Milton Friedman and Anna Schwartz for being too passive, exacerbating the Great Depression. By 2008, the Fed, under Ben Bernanke, deployed aggressive monetary policy, including massive liquidity injections and quantitative easing, setting a precedent for extraordinary interventions. In 2020, central banks globally reacted with unparalleled speed and scale, demonstrating a learned agility and willingness to use every tool available. This shift highlights a profound change in central bank philosophy, moving from a cautious observer to an active, often preemptive, guardian of financial stability. Beyond policy, these crashes illuminate fundamental aspects of investor behavior and market psychology. In all three instances, periods of irrational exuberance, fueled by easy credit and herd mentality, preceded the downturns. The subsequent panic selling amplified losses, demonstrating the powerful influence of fear and greed. Behavioral economists like Daniel Kahneman and Amos Tversky have extensively documented these cognitive biases. While regulations attempt to constrain structural risks, human psychology remains a persistent, often unpredictable, factor in market dynamics. The emotional roller coaster of bull and bear markets appears to be an enduring feature of financial history. So, what critical lessons can we distill from these historic financial disasters? Firstly, financial systems, despite continuous evolution, remain inherently vulnerable to various forms of shock, be they internal speculation or external pandemics. Secondly, the speed and decisiveness of government and central bank intervention are paramount in mitigating the worst effects of a crisis. Thirdly, adaptability is key. Each crisis demands tailored solutions, as the vulnerabilities of one era rarely perfectly mirror the next. As economist Hyman Minsky's financial instability hypothesis suggests, stability itself breeds instability, leading to new forms of risk-taking. The question is not if another crisis will occur, but what form it will take. Each of these three crashes, 1929, 2008, and 2020, serves as a powerful historical marker, not just of economic devastation, but of profound learning. They highlight a continuous evolution of financial risk and the dynamic interplay between market forces, human behavior, and policy responses. From the nascent regulatory environment of the early 20th century to the sophisticated interconnected global markets of today, the challenges of maintaining financial stability are ever present. Governments, regulators, and investors alike are in a perpetual state of adaptation, trying to foresee the unforeseen, to protect against the next systemic shock, and to build a more resilient global economy.